This week on Phil's Tax Hacks and Other Retirement Facts, we're going to talk about the BBB. You knew we were going to do it. So let's talk about some of the things that you can quickly search and the answers you get, and then what it actually might be if you go look at the actual website and the actual bill summary. Let's get into it this week here on the podcast. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into the podcast. Thanks for hanging out with Phil and I as we talk investing, finance, and retirement. And Phil, almost kind of a top 10 of the BBB a little bit we're going to talk about today. The big, beautiful bill. You know, if you've watched this show at all, you should know we're going to do that because it's, you know, it's finance.
It's taxes.
It's taxes, right. But interestingly enough, you sent me this really interesting summary that you got straight from the government website and straight from the bill and the information there.
Yep.
And so I compared that to just doing some Google searches and some other different kind of searches. You do a chat GTP and various different things just to see what some of the information is and see how well they line up. Thought this was interesting.
Yeah, I mean, that was one of the challenges I had in preparing for this, trying to get a summary of, okay, give me the highlights. And I use Perplexity a lot of times, another AI tool for searches. And same thing. I mean, it would not give me a summary. It points to all sorts of articles, but every article it pointed to gave, tidbits here and there, but had different spins on it. And it's like, look, I just want the facts.
Right.
What does the bill say? So I can get an idea of what changed and what was made.
We're entering this interesting phase, right? Because we've all been saying and seeing for a while that we know that unfortunately, mainstream media definitely has political slants to it. Everything has just been crazy the last 10 years in regards to that stuff. It's very hard to or 5 for sure. And so it was like, okay, well, the AI stuff just regurgitates the actual information. And so therefore it should be more factual. Well, it's beginning to look like that's not the case either.
Because it's pulling from all the different news media sources out there that's writing articles on this right now.
And being programmed possibly. So It's interesting. So anyway, I thought this would be, because I was like, hey, let's just talk about some of the main topic points this week and let you just kind of give us your feedback on it. And then you sent me that kind of, kickback saying, well, actually some of this stuff goes against what I kind of Google searched and various things. So let's just get into it and kind of highlight some of the different things and hopefully we'll get to the nuggets of useful information. All right. So the big piece that I think a lot of planners, advisors, and of course, people getting closer to retirement, well, everybody really in general should be happy about this piece of the BBB. I know there's a lot of contention around it, but the extension of the TCJA should make most people happy, right?
Correct.
So we're keeping the tax rates and the brackets the way they are.
Yep. So the 10, 12, 22, 24, et cetera, those rates, the brackets that were introduced back in 2017 are not expiring now. Those are now made permanent under this law. So
at least until the next administration.
Well, as permanent as a tax law can be. So.
Yes, permanent as politics allows. But anyway, go ahead.
Yeah. So, I mean, that's the biggest piece of it is that we now have certainty to know what the law states going forward indefinitely until it gets changed. We now have those lower rates locked in. So that's a good thing.
And especially for planning, right? Because now, like the Roth conversion conversation. Well, if that was on your radar, but you thought you were going to run out of time as far as, the current tax rates could have expired in 25, which they will now not. But now if your plan called for Rothing over time, for example, you've got time.
Right. And that's kind of been our approach all along is we're doing conversions over time. We had ramped up some of the conversions a little bit earlier with the anticipation that, possibly the TCJA would expire. But I mean, we talked typically going between the 22 and 24%. So, I mean, it's not a huge difference. So,
right. Yeah.
But to me, the biggest piece now is just we have the certainty. We know we don't have to, no longer guess of what could happen.
Yeah.
Again, like you said, until the bill gets changed again, which I'm sure it will.
Yeah.
The way tax law changes over the last 10 years, it will not be long until we'll be looking at something new. So,
well, I wasn't looking forward to 24 going to 28. I'll say that. So
yes,
I'm glad it's staying where it's at, Yep. All right. So that's kind of the big one. And it's pretty simple across the board. Taxes stay the same. Brackets stay the same. Should make most people happy. I don't know that anything makes everyone happy anymore. But number two,
yeah.
Number two, SALT deductions. Let's talk about that a little bit. The cap increased again. From my search, it says the cap increased to 40,000 for a 500,000 AGI. So, what is SALT deductions, and what does that mean?
Yeah. So, if you itemize deductions, your state and local taxes. So,
SALT.
State income taxes, right? Your local income taxes you pay, your property taxes, sales tax potentially plays into that. So that whole category was summarized or acronym of SALT.
Right.
So those under the TCJA were limited to $10,000. So for many states, especially those that have higher property taxes, and an income tax in place, Michigan is a great example.
Yeah.
It wasn't hard to cap out the $10,000 deduction.
Right.
So under the new tax law, they have increased it, and this is one of those just funny nuance differences, and it might just be rounding. So the actual tax act is 40,400, and your summary says 40,000, no big deal.
Not a big deal there. Round it off.
But yeah, so it is the 40,000 limit, and it's reduced once your AGI goes above 505,000 for married or 2025 for singles.
And is that income?
Yes, adjusted gross income. So think of front page of the tax return.
Okay, gotcha. So if you're making it above that, it'll change. And then this is also. Does this have a phase out?
How it works, but it phases out. Yeah. But it won't go below the 10.
Gotcha. Okay.
So the extra, the higher limit now, 40,400 is the new deduction, and if your AGI is above the 505 or 2025. It will start to phase out, and they don't have all the details yet on that. But I shouldn't say, it wasn't in the summary. Let's put it that way. I'm sure it's somewhere deep in the bill.
Maybe.
I didn't go through all 6,000 pages.
You didn't go through 6,000 pages over the 4th of July weekend to prepare for this, Phil?
So
what's wrong with you?
But there will be some phase out that'll drop it down, but no lower than the $10,000.
So we're taping this. We're in the first full week here of July on this podcast, folks. And as always, we appreciate you hanging out with us. And don't forget to subscribe to us on Apple, Spotify, YouTube, all that stuff. But I could just see you sitting in the camper last week over 4th of July holiday, reading the entire bill, and your wife going, "What are you doing?"
That's right.
You probably wouldn't be here today because she probably would have conked you on the head or something.
That's right. Yeah. Yeah, on our vacation, she reads novels. I read some kind of technical things.
Yeah, but not the entire tax bill, I guess. Right? You weren't glutton for that much punishment. So
no, not at all.
All right, let's get to one of the ones that definitely a lot of our demographic was certainly interested in. That's the expanded standard deduction for seniors. We saw some disparities here. The information I kept getting kicked back on most sites was saying an extra $6,000 deduction for taxpayers 65 and over for a 3-year window. What's the summary say? Yeah,
so the standard deduction, they did a couple of things. So for those that are 65 or over, what the bill summary says is it's $4,000 per individual.
Okay.
And the key to this too is that's through 2028.
Right.
So
correct.
It's really the next 4 years, you get this extra 4,000.
Yeah.
Versus the 1,500, which is standard.
And the information that we're seeing on that you can quickly Google is 6,000 per taxpayer. So little disparities there on some of that information.
Yeah, and again, so this is going to be phased out. So if your adjusted gross income is above 150 for joint, 75 for single, then this additional 4,000 is going to be phased out. So
yeah, and my source came from the Wall Street Journal, as well as AAR BCPA, which is also tax breakdown. So interesting that they have a higher number, and the actual summary is 4,000.
Well, so they might be kind of blending in the other deduction that they made or change they made to the standard deduction, which is first making permanent that higher level of standard deduction, which for this year, 25 to 15,000 for single, 30 for married. But the bill provides an additional $1,000 per person, 2,000 for joint.
There it is.
Through 2028, but that's for joint.
Yeah.
So that still doesn't come up with.
Yeah. Interesting, right? So it's important for us as taxpayers and consumers and all that kind of stuff to just, again, this is why one of the reasons we talk often about, building wealth, in your 20s, 30s, 40s, a little bit easier, maybe going and doing the big box tax places for your, tax stuff, or doing, online or whatever. But when you start getting closer to retirement, I feel like 50 and over, you really want to start thinking about having a team, right? You really want to start thinking about having that financial professional, a CPA. Of course, you're both in one, so to me, that's a win-win. But I feel like, because there's a lot of nuance to this, right? And they can fudge the numbers a little here and there when they do some of this stuff.
Right.
It gets confusing.
Yeah. So unless you want to spend the time digging through the bill and figuring it out yourself, I mean, it's this one especially. There is a ton of changes in there. Effective this year.
So from as a planner standpoint, good. This a good move for a couple of years for folks?
Yeah, no, absolutely. Because it gives the permanency of those rates. I mean, that's one of the big, concerns that we had going into 2026 is what the rates would be ultimately going up. Given some provision for the SALT deduction, I mean, that's good. That was one of the biggest downsides I saw to the TCJA was for those that could itemize. I mean, it's just way too low.
Yeah. So and the 4-year window for the senior, I mean, I think it's still going to be helpful for them. It's not exactly what we were hoping for, but
no, I mean, it's a little something, but it's
a little something. Yeah, it's like going fishing and catching a smaller fish than you wanted.
Yeah.
Same with the next one, which was the temporary above line deductions. The tax on tips, for example.
Yeah. So, I mean, the tips, up to 25,000 exclusion, overtime pay up to 1,250, and then auto loan interest up to 10,000. All above.
That's an interesting one. What is the deal on that, Phil?
Who knows? I mean, it's probably a payback to automakers for for whatever reason. But it's a means to, I think, encourage people to buy new cars or buy cars.
Okay. To kind of spurn on the auto industry. Yeah. I think it's going to probably.
It doesn't say anything specific about a new car. It just says interest
and it's U.S. built cars, of course, obviously.
Right. 25 through 28. Right.
So I think it's kind of a little bit like they still got to kind of figure out the information. So, it's hilarious. A lot of the platforms, if you say a certain word, which I'm going to say here in a second, they tend to squash your viewership and stuff, which is silly. We should not live in a world that does that. But let's talk about the Trump accounts, okay? Because that's another one where, to me, this seems like a great idea. Right. So $1,000, right, to get started in an S&P index fund for kids, and this thing could grow, for years. This would be awesome.
Yeah. So, I mean, it's for the $1,000 is what the government actually is going to kick in for those born between 25 and 29.
And I'm assuming that's probably going to be off the tax. It's probably going to be a tax break off of there. You're not going to get a check, I doubt. I imagine.
No. It's going to go into that Trump account. So if you open up a Trump account, then they'll do this. And then you can contribute up to $5,000 per year to the Trump account.
So to me, that's a great way to get kids started off on the right thing. And I know they're going to have to kind of figure out some of the, when do they have access to it? I think there's still a whole lot of back end stuff that they haven't kind of sorted out.
Yeah. And again, and so they've given some, indication in that summary of what it can be used for. So it's for certain higher education related expenses, small business expenses, and purchases of a principal residence for first-time home buyers.
Okay. That's all good things.
Which is it's kind of cool. So, I mean, it's not just education. Nothing wrong with education. I love, all the benefits and incentives for education.
Yeah.
But, I mean, especially in today's environment with the cost of education, that's not a good fit for everyone.
Well, it feels like
trade schools and all these other things, small business expenses. I mean, that's great.
Well, it feels like an evolutionary bump up to what they already kind of did a few years ago with the change in the Secure Act 2.0, where you could then take the 529, and if they didn't go to college, you could roll that into a Roth. Right. So it just kind of just feels like another kind of piece of, hey, we're trying to set, the younger generation up to, get off onto the right foot for long-term planning versus just wait until the last second.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of The Tax Smart Retiree right now.
There's a whole bunch more stuff we could dive into, Phil, but what else do you think? Like what hit you, struck you? What's affecting you as a planner? What's affecting you for your clients? What's some of the pieces that you want to talk about and take away there?
Let me just run through my list real quick. So a couple other ones that I thought were pretty interesting were on the HSA.
Okay, let's talk about the HSA. Yeah,
health savings accounts, great idea. But the challenge has always been, especially for retirees, once you become Medicare eligible and sign up for Medicare, then you lose eligibility. You can no longer contribute to an HSA account, even if, let's say, you got a supplemental plan that is a high deductible plan, and they make those.
Right.
So under the BBB, it now opens up the eligibility for those that are over 65, so Medicare eligible. Again, we don't know all the details and ins and outs on how that works, but that's kind of cool.
Okay.
So there could be a potential for those that are in retirement to maybe still contribute to HSAs. So
okay. Yeah, and the HSA is a great tool. Like we've talked about that many times. Awesome. Yeah.
I was going to say quickly on the HSA, they did increase, kind of a bonus type contribution, $4,300 for individuals, $8,550 for family, adjusted for inflation. But again, that's going to be phased out if your income's over $150.
What'd you think about the tax exemption, the estate tax? So they increased it. I think we all thought they were going to lower it. Yeah.
Well, it was slated to be lowered, so they left it through 25 as it is, but then in 26 going forward, we now have a stated higher level. It was 15 million.
15 million, yeah.
And they've indexed it now in there for inflation. So they've got it written in for indexing, which is,
most people weren't even getting to the 13 million.
Right. But yeah, a lot of these key points, they do have indexing built in now too, which is key. I mean, there's, like the child care credit. Now it's indexed for inflation, the estate tax. A lot of these different pieces are going to be indexed.
Right.
So that they don't, over time become less and less relevant, much like taxation and Social Security, but that's a whole other topic.
Yeah. I mean, fundamentally, I guess, those are some of the key points. We can talk about some of the broader, fiscal pieces. Obviously, the big piece of conversation is the $3.5 to $4 trillion of deficit over a 10-year period. But it's interesting. So the information I got and put in there comes back at 3.5 to about 4 trillion over 10 years, where the big news headlines is it's adding 5 trillion, right? Or 6 trillion, right? So, it kind of gets all over the place there. Some of that misinformation or whatever. So we're not exactly sure what it'll do. Obviously some cuts to Medicaid has been also the big conversation piece. I don't want to get into the political aspects of that because that's not what we're trying to do here, but hopefully it doesn't seem like this should affect most seniors. We'll see.
No, not at all. I mean, from what I read through the summary, and I would encourage people to do that. The summary is readable. I mean, I think it's almost 30, 40 pages, but I mean, it's kind of categorized so you can run through it pretty quickly.
But if you're concerned, that's a good idea. Yeah.
Forget all the articles. Don't do a Google search on it because all you're going to do is get some article written by somebody that has their own spin on what they want to portray.
Exactly.
Go to the bill directly, look at the summary. It'll give you actually every section and kind of a quick summary of what's in that section. So,
well, what's your overall takeaway from a planning standpoint? So for your clients and things of that nature that people are saying, they're reaching out and saying, hey, Phil, are we making changes or what are we doing? What does that look like? No,
I mean, overall, I think it's good. It gives us that known number now for the taxes going forward. So we now are, we've got a lower limit that we can plan on for an extended period of time, not wondering if, that potential of the higher rates.
Yeah.
Roth conversions are still absolutely in play. I know a lot of people were maybe approaching Roth conversions because, the tax rates are going up.
Right.
We looked at it that way, but over this last year, we've looked at it both ways. Well, what happens if it gets extended?
Right.
Like it actually did. So, and for our clients that we're doing Roth conversions, we always looked at it both ways over this last year as we approach conversions just to see if this does get extended, does it change our approach, and it hasn't. So,
well, at the time,
this opens up a window of opportunity.
Yeah, for sure. At the time we're talking, the S&P, which is usually the index that most people use as their reference point, is it set a new all-time high last week, I think, at 62.84. It's at 62.27 right this minute. So it seems to have rebounded fine. Now we're going to probably do a podcast here shortly on the looming tariff thing, or maybe we will wait to see after they kick back in.
See what happens, and
and see how that plays into it. But I think ultimately, fundamentally, when you're talking about planning and strategizing, especially for our senior years, now having some information in place that you guys can work with, kind of gives you a better bedrock of, okay, now let's get in there and tweak plans if we need to tweak them, or set plans and so on and so forth.
Right. Yeah, it just gives us that certainty to know, again, like we talked, as certain as you can be what the tax law is going to be for the next 5-10 years, whatever it happens.
Or at least 3.5. We'll see.
Or at least 3.5. Well, probably 4. Let's give it that.
We'll give it 4. Okay, yeah, maybe 4.5. Yeah, all right.
Some time to get things changed. So.
Very true. Very true. All right, folks. Well, hopefully that helped you a little bit with some of the viewing of the BBB. Again, I think that's a great point. We can put a link into the summary as well in the show notes. We'll put some other links in there for you to check out. But fundamentally, just go read the summary yourself. Like I said, it's 30 or 40 pages. If you're concerned and you don't want to get biases from our show or anything else, right, or any other thing, go read it for yourself. I think that fundamentally that's a great point. So, but if you need help when it comes to planning and getting something set and getting a retirement strategy in place, then reach out to Phil. Get yourself onto the calendar. If you got some questions, reach out to him. Let him know. We'll have all those links in the show descriptions below. Don't forget to subscribe to us on Apple, Spotify, and of course YouTube. Hit that subscribe button, the thumbs up, and the notification bell. Certainly supports the channel and helps us out, so we can come back and smile at you and talk about stuff like this. So we'll see you next time, my friend. Have yourself a great week. We'll catch you later here on Phil's Tax Hacks and other retirement facts.
Phil?
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.